Hello everyone. The month of Feb was a little bit of a mixed sentiments from a bond market standpoint, where we saw a rate cut definitely which acted as a small sentiment booster for the bond markets because it was a little bit of a surprise for certain sections. So we actually saw the long bond yields, specifically in the sovereign side, inch up, but the short end of the yield curve, which is the 5-year and below segment, come down. So in that process, what we saw is a steepening of the yield curve. The liquidity in the system continued to be monitored. We saw open market operations continue in the month of February. But apart from these, and of course the Valentine's Day celebration, we also saw some geopolitical risks unfolding which created some ripple effects on the markets. So on balance, while on a month-on-month basis, we broadly ended flattish in terms of yields, the heightened anxieties on the side of the market participants as a fallout of the geopolitical issues, and more importantly, how higher could this get escalated, kept the markets a little bit on the nervous side. The good news is that the third quarter GDP data, which came in at about 6.6%, has given some more wings to the bond markets, which has seen a small lift up in the sentiments. Added to that, the Reserve Bank of India has also announced open market bond purchases for the month of March. And in addition to that, has also announced a long term, which is a term repo for the bond markets, which goes beyond March. Now, these measures are being taken to inject liquidity into the banking system. Why do we need liquidity? For two reasons: that if we have seen a rate cut in the February policy, isolation, it may not work. There has to be a transmission of that rate cut into the real sector, which means the banking entities, the financial sector entities actually need to do onward lending. If there is no liquidity, how will this lending happen? And therefore, the focus on creating that liquidity in the system alongside an enabler of rate cut to be able to get the economy to the desired growth path. Inflation at this point in time is not a concern. Liquidity, we assume the central banker will continue to maintain through the various tools available, because, make no mistake, this is an election year in 2 months from now, and therefore the currency in circulation, which is the cash that moves out of the banking system in the hands of the average Indian, is only going up. So I think a combination of these measures, we believe, will be the defining way for the markets going forward. So where do we think exactly the curve is positioned, and where we think there is value that lies ahead? So we have been seeing this for quite some time now, that the short to middle end of the yield curve is where we find a lot of value. So within the lower end, it is a 6 to 12 month bucket, and in the midterm, it's the 24 to 30 month, broadly the 2 to 3 year bucket, is where we believe there is an incremental value unlocking that could happen. So for those investors who are seeking to enhance duration on the fixed income portfolio, say from liquid to ultra short term category, or maybe from ultra short term to low duration and short duration category, the timing could definitely be opportune. The credit situation in India is unraveling itself gradually. The good news is that the risk premia for owning the non-AAA bonds, especially in the lower rated space, is getting to be reasonably attractive. But it is important to cherry pick these assets in a market like this, because it's a buyer's market if one wants to create value over the next 3 years. The cycle has been such that we are seeing downgrades as well, but please appreciate every downgrade need not be equal to a default. It is a credit cycle. There will be upgrades, there will be downgrades. It is left to the prudence of portfolio managers to manage the portfolio on a holistic basis. In conclusion, we believe that the market will continue to be buoyed by sentiments of low global interest rates, comfortable liquidity in the banking system, and keeping options open of expectations of future rate cuts, which means the overall fixed income pack from a 1 to 3 year investment horizon definitely considers a relook. On that note, happy investing. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.